Welcome to the Mind of a Millionaire podcast, where we discuss the habits, routines, and choices that lead to financial independence. Today on the podcast, the November portfolio meeting. So on the first Tuesday of every month, all the advisors at Denver Wealth Management get into one virtual room, and we discuss the year-to-date, 1 year, 3 year, 5 year, 10-year performance of our investments. We look at the projected investments or the projected return of stocks, bonds, mutual funds, commodities, real estate, alternative investments, all of that good stuff. And we decide how to position our capital to maximize either the return or the risk of our various portfolios. What's up, Austyn? That's my intro.
Yeah, no, great intro. Great intro. We didn't really delve into what we were talking about today, so I'm learning too, and that sounds like a great.
Well, you were in the meeting. No, I don't accept that answer. You were in the meeting. So maybe you don't remember, but you were there.
That's all right. I'm excited. It's like it's fresh now. It's new, and I'm excited.
So I would say the biggest thing that we talked about at the November portfolio meeting is U.S. corporate tax rates. And under President Donald Trump, the corporate tax rate started at 35%. President Trump and the Republicans dropped that down to 21%. And one of the things that presidential candidate Joe Biden had promised was to raise tax rates to 28%. So all year we have been factoring in this tax rate into our valuation of investments. And if you think about it, let's say you own $100,000 in an investment, like in any individual company, and your share of profit is $10,000. Okay, so when you earn that $10,000 or your shares do, the corporation pays tax. And if they pay tax at 21%, that's $2,100 that goes to the federal government. Tax rates go up to $2,800 or 28%. That's $2,800 that you would pay in federal taxes. So when we're looking at the value of investments, we are expecting taxes or company stock to be worth less when tax rates go up. So what happens when we are expecting tax rates to go up and it very much looks like they're not going to? Well, it means that the stocks or the equities are worth more. So basically, the fact that the Democrats and President Joe Biden cannot get this tax hike passed is really good for equities. And it's really good for shareholders of equities. And that's one of the reasons we expect the stock market to do, reasonably well in the short term, because we all get to readjust our earnings forecasts for these companies.
Would you say that that's already priced into the market?
No, I would not say that. Goldman Sachs still puts a 25% probability on there being a tax rate hike this year. So it's still not completely improbable that they could come together and pass it. So it's not ever fully priced into the market, but I think it's fair to say that 75% of it's priced into the market. And also it's not like absolutely common knowledge. It's not like every investor in the country is going to get together and say, we think tax rates are not going to happen. Therefore, we can all adjust our cash flow models for these companies. So it's not like secret information, but it's not information that everyone's discounting. And therefore, it is not completely priced into the market. But the other thing is we were all factoring in, like in our previous portfolio meetings, as I'm sure you remember, is we and every other group were thinking that when they pass these rate hikes, you're going to see a sell-off because the companies are going to be worth less. And now, now Joe Biden and he basically, it seems like they've settled. They tried to pass a tax on the 700 billionaires in our country, and then that didn't work. And basically they settled on a 15% minimum global corporate tax, which they got a whole bunch of countries to sign off on. But as a country with a 21% tax, that's not a big deal because maybe a few less countries will or companies will go to Ireland for their low corporate tax. But it's ultimately not going to be a big deal in our opinion. So that was thing number one, is the U.S. stock market appears there. That's definitely like a tailwind for the U.S. stock market, since shareholders of companies will now get to keep 7% of their earnings that they did not expect to get to keep previously. Issue number two, affecting investors is inflation. And it's so interesting to think about this. Inflation kind of came on everybody's radar back in, March, April, May, when the price of lumber absolutely went through the ceiling and people started saying, hey, everything's getting expensive. And back then, I remember talking about this in our May podcast. We talked to a lot of almost every single mutual fund and professional investor we work with in this like 2 to 3 month time frame. And to a person, every single one said inflation is transitory. We do not expect it to continue at this rate. And now we just got, I think, the highest inflation reading since the 1980s. Yeah, I can't remember the exact stat. And now everyone we talk to is saying that it's going to be around for a few years. And it just makes me realize how much the industry is, there's so much groupthink. Like, it's so hard to go against the grain, because if you go against the grain and you're right, no, let me think about that. If you go against the grain and you're wrong, everybody remembers. So like if I'm out here in May saying inflation is here to stay and I'm wrong, I'm kind of standing here all alone looking foolish. But if I just say the same thing as everybody else, it doesn't matter if I'm right or wrong, because at least I didn't stand out. And you're seeing that a lot among these mutual fund managers and professional investors. They are always, no matter what the consensus is, they are in the consensus. And it gets hard to really decide like what is true and what's not true. Is inflation really here to stay, or is it just kind of a temporary byproduct of this crazy federal reserve intervention? So it's, I don't sit here and I'm going to try and rise above that and just say, hey, I'm not going to be the guy that predicts inflation. I don't know if it's going to be 6% or 1% or 12%. We're not in the business of predicting the inflation rate. We're in the business of trying to buy companies that we think can have an adequate return to shareholders. But it makes you realize that there's a lot of, go ahead. It just, to conclude that thought, it just makes you realize that if you're trying to base your investment decisions around like something somewhat esoteric like inflation or interest rates, you're going to have a bad time.
You're going to have a bad time.
Quote South Park is what I was doing there.
Yeah. I got the reference. I'm young. I'm cool. Okay. A couple questions. I mean, you kind of touched on it at the beginning of that, in that you had all of these fund managers and analysts a year ago saying that inflation is transitory. It's not going to last. And then you see this shift where now all these fund managers and analysts are saying, yeah, it might last a little longer. Just kind of going to that whole group thing, but it's changed, and the group has changed together. So no one's left out. No one was, out of that whole thought process. Who's to say that doesn't continue to change? And, 6 months from now, the whole group is thinking differently. So again, there's no one who stands out. And maybe I'm wording this wrong, but if that's the case, then how can investors prepare themselves? Or what signs do you look at?
I think the answer is, I'm going to summarize your question to make sure I got it, because Thanks. you did go a little auto-tune on me. With, I know, our company's Wi-Fi problems, which are ridiculous because there's only a fraction of people in our building than there used to be. But basically, like, how do you make a decision if the people who are supposed to be the most informed are always just kind of jumping on the bandwagon? And my answer to that is, there's a direct answer and indirect answer. The direct answer is you don't, right? You don't make decisions based on what the consensus or CNBC is. Because, if you follow CNBC, I used to have CNBC on every day, and you would think there was only 6 companies in the world. There's Apple and Facebook and Tesla and Twitter, and that's all they talk about. And it kind of gets you like myopically, granularly focused on these few companies that the media is interested in. And that's no way to invest. And you could say the same thing. If you let yourself as an investor be swayed by the topic du jour, right? The topic of the day. That's as much French as I know. I'm just pretty sure du jour means the day, right? Soup du jour, soup of the day.
I know je m'appelle.
Oh, shoot.
That's it.
I don't know that. You're just setting yourself up for a disaster, because you're always going to be focused on what the media is versus doing your own homework and your own research and deciding what you should be doing. So that's the direct answer, is you shouldn't do it. But the indirect answer is, You shouldn't be making investment decisions based on inflation, kind of. So I guess instead of a indirect answer, it's like a wishy-washy answer. If you think inflation is really going to come up, there are definitely assets that do terribly during inflation, like fixed rate bonds. And there's definitely investments that seem to do the best during inflation. And that would be like companies that have pricing power. So like Coca-Cola has pricing power. US Steel has a lot less pricing power because, so anyway, I won't get into the details of that. So if you think as an investor that inflation is going to be consistent, you would want to buy investments that seem to outperform inflation over time. But I would not let whatever talking heads are talking about influence that decision. I think you need to go look at the data yourself, and you need to go be diversified. So even if you think inflation is coming, you don't bet all your money that inflation is coming. You don't put all your money into tips. Maybe you put some of your money into tips or treasury inflation protected securities, but you don't ever bet the farm on a single idea like that.
Cool.
Okay. Number 3, supply chain issues. So since we're talking about the topic du jour, one of the topics that loves to be in the media right now is the crazy supply chain issues. In fact, if you're on Twitter, it was really cool to see some random guy on Twitter he rented a taxi or like an Uber. It was a taxi or something. And he drove down to the port of Los Angeles and, oh no, he rented a boat. He rented a boat and went out into the harbor on the port of Los Angeles and individually found out what the bottleneck problem was. And it turned out to be that in Long Beach, the law was you can only stack your containers 2 containers high. And he just spent one day at the port of Los Angeles or the port of Long Beach and said, hey, if you let these people stack your containers 4 containers high, it will completely alleviate the supply chain issue. And it was so cool because then like just a little bit later, the mayor came on Twitter and the mayor actually changed the law in an emergency situation that the port can now stack their containers 4 high. So even though, did you see that, Austyn, that whole drama?
I didn't. That's so cool. But I mean, I was thinking about it earlier, kind of on that point of citizens rising up and taking action on this. If you could just rent a truck and go down there and pick stuff up. I personally could not. I can't drive a truck, but people get creative, I guess. That's kind of the theme of it. And that's really cool to see.
I actually drove a semi-truck fully loaded one time in my life.
Of course. Why wouldn't you? Every time we have a podcast, it's a new skill and a new career that you've had.
My dad was a truck driver, and there was this one summer where I used to ride in this truck, and when you back up your frozen fish sticks or whatever you're hauling around, it's called being a lumper. That's the job, as a lumper. A lumper is the guy who takes the stuff out of the truck and puts it in the warehouse. So I was his lumper. And once you wait in these long lines. So I guess I've been waiting in supply chain lines before. You wait in these long lines till it's your turn to dump off your cargo. And we had to scoot forward like 12 feet, like it was a traffic jam, right? And I said, hey, Dad, can I scoot the truck forward 12 feet? And he let me do it. It was awesome. Like if you've never been in a truck that pulled thousands and thousands of pounds, it is truly awesome. But that's my lumping story. But I was gonna pull this up and see if I could find the guy's name, but I actually found it through Scott Adams. So I'd have to go like through the rabbit hole to try and find who this Twitter guy was. But
we can put it.
We're talking a lot about supply chain. Oh yeah, I don't think it should be too hard to find.
No, on there.
But basically, the supply chain issues, they'll end, and they'll end because there's financial incentive for them to end, right? If nobody in your town has Legos, and you can find a way to get Legos, you're going to make a fortune. So therefore, creative individuals will solve those problems. And there's no doubt in my mind that will happen. So there are people making investment decisions based on supply chain issues. We are absolutely not doing that because we just know that's going to get solved here in the near future. And supply chain issues are bad for almost everybody. So they will go away. I have a lot of faith in that.
I agree. I read something on that the other day that I really liked, and it's essentially exactly what you just said, but we're in this transitional period. Nothing about the past year, 2 years has been ordinary. So I think that at some point in time, we will be forced to find a solution for it. And so that's reassuring. As far as the time frame of when that is, that's a little bit murky. But like you said, when profits are on the line, people will find a resolution and figure out how to get that supply chain alleviated.
Yeah, actually, one interesting, that thread is so fascinating about the guy who rented the boat. One of the people who commented on that thread is the governor of Texas, and I think his name's Abbott, but I'm not sure. And so there, not only are there so there's like a ton of bottlenecks. So there's like a bunch of ships in the harbor waiting to dump their cargo. There's all the cargo waiting to get loaded up into these giant piles, and then there's all the trucks waiting for their container. So the governor of Texas went onto that Twitter thread and explained to the shipping companies that if they go through the Panama Canal and around to Texas, that they will actually get their cargo unloaded faster than if they wait in the current lines. So that's another way that will get alleviated. If the Port of LA, if everybody knows the Port of LA is completely gummed up, they'll start going to Texas. In fact, one of our clients, he runs container ships from I always say North Korea, I don't know why, South Korea, through the Panama Canal all the way to the East Coast. So I don't know if it's Florida or New York where he drops off his shipments, but it's a really crazy industry, and there's a lot of smart people there, and it'll just get relieved, or the supply chain issues will get relieved. So there's no point in trying to make an investment decision based on that. So, but it's in the news, so we talk about it. And then last of all, small and mid-sized companies are having a bad year relative to large-sized companies, especially growth companies. And it's important to remember that it seems the way the stock market works is if something has a really good year, like small cap growth had a really outrageous year last year. A lot of small cap growth mutual funds were up over 100%. There's a lot of index funds that were up, I think, 30-40% last year. So it's not surprising that this year they wouldn't be the best performers. And I think small cap growth as a category is up. Oh, I changed my, let me pull it up really quick. As of November 1st, small cap growth was up 7.6% on the year versus growth companies being up about 24%. So it can be very tempting in times like these to say, well, my small caps only made me 7%. I'm going to sell those. Well, that's the exact opposite of what you should be doing. What you should be doing is looking at the things that are up a lot, like large cap value companies and mid cap value companies, and saying, should I sell some of that and buy what's gone down? Meaning the small cap growth that had a lousy year. So that's why the investment process is so important, because it's so easy to fall in love with like an investment that goes up in value. I was going to name one that I'm not going to name because I don't want to get in cryptocurrency trouble for saying it, compliance. But if you have an investment that went from, say, $100 to $60,000, it can be really tempting to want to buy that because it keeps going up. But that's actually the opposite of what you should be doing. When your investments go up, you should be compelled to sell them and buy the thing that's gone down. So this would be a time when we rebalance in 2022, we will very likely be adding to our worst performers of 2021, which in this case is currently small cap growth, is one of our worst performers. And we'll be selling what's gone up the most, the large growth and large value companies. So go ahead, Austyn. I was going to wrap it up.
That's all right. I have a quick question that kind of maybe gives more action items in direction to listeners. But you're not saying just to buy companies because they're down next year. So in what environment should these investors be buying small cap companies? What should they be looking for? And why do you think that small cap will do well next year?
Okay,
or
so that's
I guess the other question on that is, your phone's ringing in your office.
Oh man, I can decline that. I can decline that from my home office.
Crazy. Why?
Okay, so
why will
that's
small
a really
cap companies do well, and why will large cap companies or those mid value companies? Why do you think they're at a peak and folks might want to sell out?
Yeah, I got to make a note here.
Lots of questions in one question.
Yes. Okay. So the first thing is, you do not ever buy a company just because it's gone down in value. So like, if we're talking about individual companies, individual companies start failing and go out of business all the time. So if your criteria to buy a company is that it's dropped in value, you will very, very often be sorely disappointed when you see a company like General Electric go down for 20 years in a row, or, even Microsoft, which is now the biggest company in the world, If you look at that from its peak in 2001, I think it didn't surpass that peak for like 15 years. So you don't ever buy a company because it's going down in value. However, when you are looking at entire sectors that have a positive expected rate of return, like let's say small cap growth, the small cap growth as an entire sector has a positive expected rate of return. It has a positive historical rate of return, but it currently isn't loved in the stock market. And why isn't it loved in the stock market? Well, there's two reasons. The first I already gave you, which is that it had a great year last year. But the second is the smaller the company, the more sensitive, the smaller the company and the higher the valuation, like the higher they're stretching out the path to profitability, the greater the sensitivity they have to interest rates. So in this year where interest rates have been threatening to go up the entire year, when I talked at the beginning about, I always try and dabble in like a little bit more advanced stuff in these calls. So this is like, or these podcasts. So this is going to be a little more advanced. I talked earlier in the year about how we adjust our earnings forecasts for tax rates. And that's interesting because that is something that would happen this year. When you are analyzing a small cap growth company individually, they are very often 5 to 10 years from profitability. So you're really guessing how they're going to do over this really, really long period of time. And if you get it right, like a company like Amazon, you can make a fortune. If you get it wrong, you lose your investment. So the rate they use to forecast that growth, called the discount rate, is usually based on the 10-year treasury, or what they call the risk-free rate, which would be like the money market rate. So right now, the money market rate's effectively zero. If that rate goes from 0 to 1, and then you go put that in your model, it changes the future value of a small company like exponentially. So it's like a lever and a fulcrum that if you go far enough out, a little change over here is a huge change over there. So small cap is the most susceptible to that. And they felt that this year because interest rates have been threatening to go up the whole year. So that's why the stock market doesn't love small cap companies in whole, but the small cap companies are still having a great year. Like if you look at their earnings, it's just that Wall Street analysts are not as excited about them. So as long as the companies are still doing great, in my estimation, that is when you do want to add to them because they're not having as good of a year as other companies that are less sensitive to interest rate changes. If you had to repeat that, could you? that was a lot. That was a lot.
I'm not even going to try. I'll do a TLDR in the show notes.
Yeah. TLDR, small cap companies are the most sensitive to interest rate changes and therefore had the worst year.
And interest rates might be going up next year because of the pressure.
They might be, but you get to a point where, so like if interest rates went up to like 10% tomorrow, you would see those small cap companies just fall off the face of the earth because me and everybody else would go buy a bunch of 10% interest rate bonds. It would be awesome. We'd sell all our small cap companies. We'd buy 10% interest rate bonds. But at a certain point, that gets overdone. And in my estimation, once again, kind of a speculation, it would be very surprising to me if interest rates would go up next year. Now, we were talking about groupthink. Every year, analysts expect interest rates to go up faster than they do. So everybody's saying like maybe summer of next year, interest rates will go up, but definitely by fall. I would bet substantial amounts of money that they're not going to go up at all this next year, which means our small cap valuations should actually go up because interest rates won't go up. So therefore, I would be willing to put more money in a small cap because I don't think interest rates are going up, but the market thinks they are.
Sweet.
Do we have a listener question there? AG?
Yeah, I got a listener question. We did a podcast about this a little while ago, and I mean, it kind of touches on what we're talking about today. Kind of does it, and I want to talk a little bit more about emerging markets. I know, fun stuff. Emerging markets. So if you look at a lot of these funds, and we analyze funds all day, every day. Lots of 401ks. Look at just funds in general. Listen to wholesalers talk about their different funds. Well, if you look at emerging markets over time, the 10-year track record, 15-year track record, they're nothing boastful they're around 8%, 7%. So listener question of the day is, why would you keep, if you have a 10 plus year time horizon as an investor, why would you even keep emerging markets in your portfolio whatsoever compared to US stocks and US funds?
Yeah, we talked about this in the last portfolio meeting. And the positive reason for international investments is diversification. The US has been the dominant economic player since World War II. That's a very long time period. But we have even when the US has been the dominant economic player, there have been repeated long periods of time where US stocks haven't made money for 10 years. So if all you ever do is make money in US stocks, you could realistically have 10 years where your investments don't make you any money. And it's really easy to think that you're going to be able to get through that, but most people are not. The other thing is countries peak. I know we talked about this in a previous episode too. Japan's stock market peaked in the 90s and has been below the peak for 30 years. It is entirely possible, and I'm not predicting it'll happen because I don't know that it will or when it will. The US could peak and hit a peak for 30 years. And if you're sitting with 100% of your investment income in the US market, you're going to have a bad time. So if you don't want to have a bad time, you have to find ways to diversify your returns. And international investments are a great way to diversify your returns. So the US could have a bad decade, but maybe like South America becomes a major economic player. It certainly doesn't look like it. If you look at the problems South America has, it seems unlikely, but you can still find individual companies that have great future prospects and great earnings. So to answer your question, I don't know that you want to look at like emerging markets and say, I want to put X percent in emerging markets, but you do want to look for companies that you can buy outside of the US that can generate you returns in the event that the US stock market falls apart for a prolonged period of time.
Sweet.
All right, y'all, signing off from the Mile High City Mind of a Millionaire podcast.
Bye.
Happy Thanksgiving.